Hey everyone, so in this segment I just wanted to go over this week in stocks and the ugliness that we've had. This segment is pretty much a copy of Tasty Trade's segment, but I kind of wanted to distill it and add my thoughts to it and send it out to you folks who might want a take on how I look at these things. So, free money era ending. What does that basically mean? Well, with the free money is kind of a term that was thrown around during the COVID times because with the Fed funds rate at zero, banks, investors were pricing in the cost of borrowing money at near zero. That means that if I borrow money, I could just throw it in the stock market and make more money because the stock market was going up. And if I had money in the bank, or if banks loaned me money, I wouldn't have to pay anything for it, and I wouldn't get rewarded for putting money, quote unquote, on the sidelines in the savings account. So the stock market was blasting, and that's kind of what many analysts were saying was the reason why we had such great gains, was because money was practically free. But as you know, the Fed has been slowly increasing or aggressively increasing, depends on how you look at it. But they've been increasing the federal funds rate pretty aggressively. As you can see here in the slide, they've raised it by 50 basis points, or they're going to raise it by 50 basis points at the next rate hike increase, which was the meeting happened on Wednesday. And SPX, which is the futures of the S&P 500, was a spot future of the S&P 500, had 5 weeks of consecutive negative gains. So that's a pretty huge indication that we are nearing, or at least we are going further down for a long time, or at least we have been for a long time. And on Thursday, which was yesterday as the recording of this video, was the 9th biggest down day in the past 5 years, with the top 10, or the top 10 were pretty much happened in 2020, around that March time when we had the COVID sell-off. The 10-year yield is above 3%. It hasn't been there for a very long time. The dollar is on its high. So to kind of give you folks context on what this means is that the 10-year yield above 3% means that if you put money away in a government-backed bond today, you get rewarded 3% per year. And that is kind of, that 10-year bond yield is kind of the gauge for most growth stocks, because as many of you know who are long-term investors, the 10-year outlook is typically looking at buying more aggressive stuff, right? More growth stocks, because you can kind of forgive if they are experiencing a weak 3-year, 5-year outlook. Over the 10 years, they should be able to perform. At least that's the thesis on a lot of these growth companies. So when the 10-year yield starts to increase, the yield increases, that puts pressure on growth stocks to perform. Also, these growth stocks need to borrow money in order to make the company work, right? They have to have some form of cash flow because they don't have any, so they do so in the term or in the way of loans. And 10-year loan is something that they take money out of, or take money, borrow with. That's kind of like the going rate. That's 10-year plus perhaps their risk, which could be 5, 10, 20%. And that's the kind of the loan that they are going to take out. Now, dollar on its highs. What does that mean? You might think, that's great, the dollar is worth a lot. What it means for stocks, though, whenever you purchase a stock, you are exchanging your dollar for shares in a company. And with dollars being really high, it could be that a lot of cash or a lot of dollars are coming out of the stock market and going into savings accounts, going into cash not being invested. It could also mean that we, on a relative basis, are doing better than other countries, which if you look at it from a global scale, the US is doing a little bit better than a lot of the other countries who are still battling with COVID. We still got the war going on. And we also have other countries like Japan, China, who are still in what we would consider in America at least stagflation, where they're not doing anything. So if you look at the Japanese yen, we're actually at a 20-year plus high versus the yen, the dollar, speaking relatively. And another thing that signals is that oil is getting more expensive, as oil has to be traded in dollars, and now with the war going on, dollar has become much more of a, I guess you could say, much more in demand because of that relationship with oil and needing to purchase dollars now more than ever to buy that oil. And with oil being more expensive, it just drives the cost up on the dollar. Now, another negative implication that this has is that our exports could be going down because it's more expensive for foreign countries to purchase US goods. Now, we honestly don't export that much in the US, but it does still not bode well for companies who are in America that are selling to foreign countries for whatever trade that they might be in. Now, the VIX future curve flirted with in and out of backwardation. Basically what that means is VIX, the futures, which is volatility, when the front months are more volatile than the back months, that's indicative of, well, if I buy or if I sell now, it's more dangerous than holding onto money and buying and selling later. And it keeps going in and out because we're unsure of what the future holds. We should be even more unsure though of what further out in the future holds. And when that relationship flips around, it just basically says that we're really scared right now, more so than we're scared in the future. And having, like, when you look at normal distribution, it's like saying that today the stock market could go up $20, but tomorrow the stock market is only going to go up $15, and it throws that relationship off where each day your curve should be increasing, right? You should be having more volatility out in the future versus less. And when we invert, we tend to think that the risk is more expensive now than it will be in the future, when it should actually look more like kind of a mouth opening this way as far as where the price could go. Right now we have this huge thing this way and it's actually converging, which doesn't make sense. Anyhow, that happens though in the marketplace. Current VVIX to VIX ratio. VVIX is the volatility of VIX, so you can think of it as the second level derivative for the volatility index. And when that is low, that's bad. So normal VVIX to VIX ratio is about 5. It got down to 2.4 in March of 2020, and right now it's hanging out at 3.8. So we are not super bad, like as far as where the market was post or right in the thick of COVID, but we're relatively high. So that is to build some context over, one, if you're a bull, someone who believes the market's going to go up, it's not a bad thing to be in, right? We're not that bad. But if you're a pessimistic or a bear for market, relativity, you might be thinking there's still more room to go down. And depending on how you look at short-term, long-term investment horizons and your length of the trade, you could be thinking that this is good for me if I'm a bear, because heck, there's some more downside. There could be more upside. Who knows, right? No one really is going to know. I heard a really good kind of quote. I wouldn't call it a quote, just a really good relation to how you can look at anything, right? So if you like Boeing, nothing against or for Boeing, I don't have any positions in Boeing currently, but if you have all the charts, all the data in the world, right, and you're like, Boeing is oversold, that means it should be selling for more expensive right now, the market doesn't know what they're doing, I think, and all the charts say that the stock should be at least 50% more expensive. But then somehow a plane crashes. Stock's gonna go down, right? Almost guaranteed. But you have no way of predicting that. Same thing with the market as a whole. Apple could have a huge monopoly case thrown at it for whatever reason. Stock's gonna go down most likely, right? At least in the onset of the news. It could mean nothing for Apple, but it could go down. And then what would the chart say? A lot of the chart groups and technicians that I follow, they really don't like news catalysts, earnings catalyst, industry catalyst. What that means is that if there's anything that could go differently due to news or people coming out and saying things or industry related risk, like if an oil rig is going to go up or going to get shut down, because those things throw off all the technical analysis. That's more of a fundamental shift. But for the fundamental shift, meaning like, okay, if McDonald's is now introducing a new menu or whatever to target this new demographic of people, how is that going to affect their stock price? Will it be good or will it be a flop? No one really knows. So that's where no one knows what's going to happen tomorrow. And when you have these kinds of short-term movements, it's very hard to predict. And sometimes even if you have the news in front of you, the market reacts differently. Right, so that's a super long time on this one slide. This right here shows us the relationship between the 10-year yield and the QQQ and IWM. So the technology sector, the NASDAQ 100 and the Russell 2000, represented again respectively at the QQQ and IWM. And it shows how as the 10-year yield goes up, many times these indices fall. As I went again at the beginning of the video and I talked a little bit about how the QQQ and IWM kind of interact with the 10-year yield being above 3%. We kind of see that, as the 10-year yield becomes more attractive to investors tend to sell their technology and small cap holdings just because the risk may not be worth the reward. Could there be continuing downside pressure? I don't know. But to give us more, context around individual names, so here is the returns of April. So we're in May now. April's returns, as you can see, all these tech companies have been decimated. The S&P is almost down 10%. It might be down 10% this week, this month, who knows. Apple's down almost 10%, but Facebook, Microsoft, Oracle, the S&P tech sector, Cisco, Intel, Adobe, NASDAQ, CRM, which is Salesforce, Google with an L, Tesla, Amazon, Nvidia, and Netflix are all down below 10 or down 10% just in the month of April, with Netflix down almost 50%. So as you can see, it's not just the indices that are getting hurt. It is justified by all these companies getting hurt. And these companies aren't unknown names. These are what people would consider quality names. Apple, Facebook, Microsoft, right? All these names that are solid technology companies are getting badly beaten. Does it mean it's time to buy? I don't know. Does it mean it's time to sell? Because Netflix has such huge downward sell-off. Is Apple, Facebook, and Microsoft going to look more like Adobe, CRM, and Google in May? I don't know. And this chart here, now if you're not an options trader, you might not really kind of grasp the trading opportunity differences between VIX and the high volatility. So this is realized volatility versus the perceived volatility. And when the VIX and high volatility difference is really high, meaning that the actual volatility is more than the implied volatility. So the VIX, again, is a mathematical equation that the CBOE, the futures market, they kind of calculate and put out a product to allow you to trade that. Historical volatility, HV, is the actual volatility. So what does that mean? Quickly, if you're still in this video, you're probably really interested. So when the volatility index is calculated, and you can look at the volatility index calculation here, that's just a prediction for the future. What historical volatility is the actual volatility that is realized during that time period. So if, for example, let's say that we think that the S&P 500 has an implied volatility of 50 points, meaning it can go 50 points up or 50 points down. We don't know, but that's what the volatility index is predicting. But as we look back on the period, we find that the volatility, the actual realized historical volatility, was 60 points. That's going to be where this difference is the highest, right? It could be 70 points, it could be 80 points, right? But the implied volatility that the VIX was calculating was off. So for an options trader, someone who trades from the short side of the option, you sell option premium, you're selling risk. That's bad, as we want the implied volatility to be above the historical or realized volatility. But what this chart is showing is that as the implied volatility and historical volatility tend to diverge, right? This is the difference. It doesn't stay there very long, and it's a sharp decline. And where we are right now is we are slowly edging up. So if you are someone who looks at trends and tries to figure out what's going to happen next, well, we could either keep going up like we did here, and here, and here, and here, or maybe we take a dip again, like we did, around here. Take a dip back down. I don't know. No one really knows until it actually happens. So, what are some awesome things that happened this week? Well, we had the biggest drop since June 2020. That was last week, Friday. We had the largest surge on Wednesday. That's when the Fed minutes came out and they said we're going to decrease the basis point increase from 75 basis points, we thought, to 50. Stock market rallied. The largest surge since May of 2020. I said, and I told my friend this, the reason why we rallied so much was because I actually took a larger short position on Wednesday and I got murdered, but back to even on Thursday because we had the biggest drop since June of 2020 on Thursday. So liquidity is low and VRP is high. So basically what that means is that there isn't too much sellers and buyers out there, so the price of things can get very, very skewed because there's no buyer but there's a seller. Then the seller has to lower their cost. If there's a buyer but there's no seller, then the buyer has to increase their trade entry point. So be very cautious out there. Bitcoin was below 36, actually dipped to 35,000 for the first time since February 22nd. More on the side that Bitcoin is not an inflationary hedge. It's not like gold. And gold hasn't been a good inflationary hedge either. But I won't talk about gold today. So Bitcoin, for those of you who are thinking about doing cryptocurrency or investing in that crypto asset class, just know that it tends to act a lot more like technology stocks and the tech sector. So it's not going to be a good kind of, diversifier if you're looking to do standard or traditional stock portfolio diversification. And for those of you that want to check it out, May 3rd, the portfolio margin talk on Tasty Trade. But for those of you who are watching, you probably aren't that familiar with Tasty Trade and their mechanics. So if you are, check them out, tastytrade.com. Tons of free content. Again, I'm not in any way affiliated with them. Here's their disclaimer. This is for Tasty Trade, not for myself. I am not a affiliated with Tasty Trade at all. And for those of you who are watching, this is completely free advice from them. It is not to be portrayed as investment or individual advice. It's just for informational and educational purposes only. Many times they have a lot of fun stuff, so it's more for entertainment purposes, but it does add kind of a good, I guess, way to not be so serious on the market, because in all honesty, like when you're trading day to day, even like, you know, minute to minute, hour to hour, you have to add a little bit of humor to it, because I mean, let's take a look at the S&P right here, the SPY, right? Like, this is the hour chart, I believe, right? This is the hour. That's the day chart, sorry. So even day to day, like, we're going all over the place. To trade in this chop, no one knows what's going on. I mean, you can make your predictions, but no one's actually going to know what's happening. So I like to just say, just deal with it, you know, roll with the punches. If you're a trader, look for some kind of a trade that you're comfortable with, that you can handle losing it. Even if you're trading in on the marketplace, you know, you probably can lose all of it, and just think about that, you know. If you want to support me, go ahead and like this video, subscribe to the channel, let me know what other things you want me to go over. I tend to look at things with a little bit more of a humor side nowadays, since I've kind of stopped giving or stopped being an advisor. I kind of can give you a little bit of that professional take, but also throw in my humor, because I mean, honestly, no one knows anything. And if the last couple days show anything, it's that more than anything, nobody knows anything. Alright, you guys have a good rest of the day, have a great weekend, and be sure to check out more videos on the channel if you want to learn more. Bye-bye.